Welcome, 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 everyone. I'm Peggy Beauregard of The Nest Egg Builder. Our book is almost ready to come out. We have a book that is Build Your Nest Egg, Discover the Magic of Money and Investing. That'll be out in about a month. So I'm going to talk about that every week until it comes out so you could buy it for $20. It'll be on Amazon. And today, we are so lucky to have Justin Rupple with us. And I have this quote, which you can hardly read, but the quote is because, I like to pick something that works with our speaker. When you can't solve the problem, manage it. This is Robert Schuller. And Justin doesn't have a problem. He has a resolve for a problem for all of you entrepreneurs, owners of businesses, etc. So this will be fun. I'm really looking forward to hearing more about Justin, but let me give you a little of his background because Justin Rupel is a tax strategy expert specializing in helping business owners, that's us, and real estate investors, that's us, maximizing tax savings through proactive and advanced tax planning. We like that. As the founder of Elevated Tax Strategy, Justin works with investors nationwide to implement strategies that reduce tax liabilities, accelerate wealth building, yes, we love that, and optimize real estate portfolios, which I would think most of us already had. Yay. With a deep understanding of cost segregation, real estate professional status, 1031 exchanges, capital gain planning, bonus depreciation, and other powerful tax incentives. He helps investors uncover overlooked opportunities to keep more of their hard-earned money. Yes. Every week, they discuss a different subject and provide tips. As experts, they will answer your challenges and questions regarding finance and real estate, and you're welcome to ask them after Justin does his 20-minute what he's doing presentation. And then what questions do you have about investing as a passive investor? Do you have a deal that needs a third-party independent look? They are to assist you in reaching your financial goals, which is what we are all about. We want everyone to reach their financial goals. So it's so important to do your due diligence right. And so may I present to you Justin Rupel. Welcome, Justin. Please take it away.
Thank you, Peggy. I appreciate it. Thank you, everyone, for the opportunity to share with you today. As she mentioned, I'm Justin Rupel. My company is called Elevated Tax Strategies. You could find us at elevated.tax, and my email is justin@elevated.tax. Feel free to reach out anytime. We can have a conversation if you have any questions. A couple members of my team, Brad Birch and Gary Burns, we're all connected and work together and collaborate to help business owners, real estate investors, high income earners have a more advanced tax strategy, which actually keeps more money in your pocket, more money in your business. And for as far as real estate goes, often can help accelerate real estate growth and acquisition, which is awesome. Part of the reason why we exist and why I love doing presentations like these. Just last week, I did a 1-hour CE course for a Keller Williams real estate brokerage office. I regularly do CE courses for commercial and residential real estate brokers, talking all about real estate tax strategy. So typically, I'm speaking in those CE courses like the one I did last week for 1 solid hour. And so I'm going to try to kind of condense that in about 20 minutes so we have a lot of time to dialogue. But the reason why I exist is because there is a huge problem that many of you might be aware of in the tax world, and that is most CPAs and tax professionals that do tax preparation for small and medium business owners and real estate investors, they focus retroactively looking backwards in the rearview mirror at last year to get the tax forms filed and do sometimes very little to zero proactive tax planning and tax strategizing. So we hear every single week from many different owners and investors complaining about my CPA is not really helping me. Or they've helped me with some tax planning, but I just have this sense that there's more that I can do. And so that's where we come in. We don't do tax preparation, so we don't replace your CPA. We come in to see what's being left on the table, what opportunities could benefit you and help you explore those. So we offer complimentary tax strategy consulting on the front end, and then see if there's something that would be valuable. So that's just a little overview of who we are, how we operate, and what kind of makes us unique. Our goal is to make advanced tax strategies, the kind of things that big corporations and you know the ultra rich take advantage of all day long, accessible to the small, medium owner and investor. Like that's what we're passionate about. So that's what today is going to be. We're going to do kind of a quick walk through some different strategies. Some of these things you may have heard of before. Some of these things might be new, no problem. What I've found is a lot of times when I'm talking with real estate investors, they may have some familiarity with things like depreciation and cost segregation. They may have either done a study before, they may have heard about it before, but often what gets overlooked from the basics of getting a study done and accelerating depreciation is understanding the different ways this can be applied strategically to accomplish a wide variety of tax problems to ultimately keep more money in your pocket. So that's the strategy side is what often gets missed. And there's so much more that can be done. So first of all, some couple like basics. I always start with a couple basics so we're all on the same page. I don't want to assume we're all at any particular level. Usually we come into different places of understanding of tax. But some really basics, if I just kind of bump my camera down, I'm a little old school. I love using whiteboards and flip charts with a marker. I used to be a middle school teacher, so I would just do everything on a board instead of PowerPoints. So real quickly, if you're in business, whether it be running a real estate investment, you are a business owner, or you're self-employed, you have two financial things going on every single year. One is, this is meant to be like a little bar graph. You have income or revenue, cash flow. You're making money somehow. And so this represents the money that's coming into that year. And then also at the same year, you have some form of, right here, I'm going to write it down low, of expenses or deductions or write-offs. And so obviously we know this. This is what happens as you're running a business or operating a property, a residential rental, or whatever it might be. And so sometimes when I'm in the CE courses with real estate brokers, I ask a very basic question, but it's crazy how many people pause for a second and like, wait a minute, am I going to answer it right? What part of this gets taxed? Where does the tax rate apply? So I know everybody's muted. You don't need to unmute and say something. But one thing I always want to make sure is really clear is it's not the income, it's not the expenses, it's the difference. It's the net. So your net income, or sometimes they call it, profit. This is what gets taxed. So this is what, as it goes on your personal taxes, whether you got a property or business in an LLC or an S corp and you're the owner, it or just goes directly on your personal taxes on a Schedule C or Schedule E or however you're taxed. Whatever the profit or gain is in the year is what you're taxed on. So some of the very basics of tax strategy that we usually don't get too far into, because most often this is an area that people already got covered pretty well, is how do you maximize expenses, which can add you can raise this column a little bit of like, oh, there's something you forgot to deduct. Oh, there's something else you could have run through the business. That's awesome. That's something that can make a difference. It slowly closes the gap. But for most of our clients, there still remains a pretty significant gap. This could be from running a business, you're profitable. This could be a property or a portfolio of properties that cash flow well. So you're actually running a profit on those. Or it could be from this gap sometimes is capital gains, which means your income represents what you sold something for, like a property, and the expenses represent how much you originally paid for to your tax basis, and you got a gap, a gain. And so there's capital gains that applies, that gets taxed. So wherever there's a gap, you're making more money than you spent, you're going to get taxed on there. Now, there's a variety of tax strategies that strategists like Brad and Gary and I bring to business owners. When you're running a business, there's a variety of things you can do, like how you're structured, S corp, LLC, C corp, sometimes a combination of those, different tax credits, tax incentives that can help chip away at this to start, getting more money in your pocket, which means more money in your business. When you're running a real estate investment property, same thing. You can have different kinds of expenses and deductions you can leverage. You got depreciation, things like that. But the problem is when there still remains a significant gap, we got a big problem. When I talked to a business owner I talked to one just a couple weeks ago, he's making $2 million of profit every year. And can you imagine how much taxes he pays? He pays nearly $1 million in taxes off of that. He's the sole owner. So it goes to his personal taxes. And he only pays himself like 150K. So I'm like, so where do you get the money to pay almost $1 million in taxes? He's like, well, I have to take it out of my business. I have to take a distribution. So I literally have to drain half my business bank account to pay my tax bill. I'm like, well, that's a weight dragging your business down. Similar to you're running a property. I mean, gosh, you got to pay your taxes. So that's a drain from the profit that you can reinvest in real estate. You sell something, whether it be selling a business, selling stock, selling real estate, and if you don't do 1031 exchanges, you have a gain. Well, that takes a big chunk off the top. You have so much less money to work with. That slows the growth of your business or real estate down. So the most effective way to accomplish wiping out or significantly offsetting that gain is through real estate tax strategy. So that's what I'm going to quickly tie into. But I do this to say, like, why does this matter? Is we're looking at how do we keep more money in your pocket? And so that's where we jump to things like understanding depreciation and cost segregation. Now, I'm not going to spend a lot of time getting into all the details of this because a lot of you might be very familiar, but this is where it becomes really key. When you own an asset that is depreciating, like real estate, and you acquire property, let's say for $1 million, that property, majority of that cost depreciates, which means you can start expensing it to deduct from your income. And so, if you buy a property for 1 million, let's say 200K is the land that the property's sitting on. That's the dirt. You don't depreciate that. And let's say 800K of your purchase is the building and building and improvements. That's 800K. So this you depreciate. And so you may already know that if it's a residential property, that depreciates over 27 and a half years. If it's commercial or industrial, it depreciates over 39 years. And CPAs use what's called SL, straight line depreciation, which means they take that 800K, divide it evenly by the 27 and a half or 39, and you get a little deduction every year. That's really nice. However, you probably already know, that's why I'm going to do this part really quick, that cost segregation says, hey, a big chunk of that 800K is not real estate. It's personal property, things like appliances and carpet and cabinets and driveways and parking lots and landscape improvements. You've bought a residential property, has a pool. Well, those depreciate between 5 and 15 years. But how would the CPA be able to properly put them in the categories without a study being done that segregates those costs out and itemizes them? So that's the power of a cost segregation study, is I can extract deductions out of my property purchase and apply them to my tax liability. And so we help somebody not just understand cost segregation, but look at where are you getting taxed? It's a business. Is it real estate? Is it other forms of gains? And what do you have in your portfolio? What do you have at your disposal that we can leverage to offset? And so being proactive like that is not just, hey, I'm going to sell cost segregation studies. Everybody should do one. Actually, sometimes doing a cost segregation study, if you don't have any cash flow to offset, pulling all the deductions out and paying for the study and having a big chunk of this, sometimes 30% of it accelerated and bonus depreciation, which you may know about, sometimes it's not worth it because you have nothing to offset. Maybe you don't have much taxable income. And that's okay. So part of the strategy is looking at what helps you and what's just marketing speak trying to get you to buy a study. Do you get it? Because I've seen people market cost segregation studies and they don't bother to actually understand your tax picture to demonstrate that you can benefit from it and how you could benefit from it. And then the next step is thinking of, okay, but what's the best way to benefit from it? And that's where things come in that can be really powerful. When I work with these owners, we look at their tax picture. So to draw a little line here, we're saying, okay, what do you have that's passive income or gains in your tax? And then what do you have that's active? Active is like a W-2 job, getting 1099, like you're a real estate broker, you get 1099 or commissions if you're an insurance agent or self-employed, or a business owner, or you run a business. That's active income. And the passive side is going to be things like your real estate income is generally passive. This is CG, capital gains. That's considered passive. So when we do cost segregation and we pull deductions out of this and apply something called bonus depreciation, which hopefully Congress renews this year back to 100%, if you track that, basically it means we can pull maybe several hundred thousands of dollars deductions that would normally be spread out over like 20 to 30, almost 40 years and front load them. Now, if you ask any savvy investor and you say, hey, would you rather keep money in your pocket and invest or pay the tax today? Or would you rather would you rather pay the tax today or keep in your pocket and pay the tax later? Every savvy investor say, I'd rather pay the tax later because I can do something with that money today. I can invest it. I can grow it. And so extracting deductions and front loading them normally helps offset things on the passive column. So I worked with a gentleman who sold some stock. That's capital gains. He had a gain on that stock. So he has a big tax bill for selling several hundreds of thousands of dollars worth of stock. Well, then he purchased a real estate property for about $1 million. We did a cost segregation study, which turned around and handed him several $100,000 of accelerated deductions. Well, his property wasn't cash flowing enough that year to make a much income to offset. So if that was the only thing going on, the study wouldn't have been worth it. But we were able to apply those deductions to offset the capital gain, literally wipe it out. So now he had no tax on the sale of his stock. So he pulled stock out tax-free when you put all this together and purchased real estate with it, which is now a cash flowing property. And real estate appreciates in value too. So you get the double whammy of how do we leverage this to offset other opportunities. Another one is I worked with someone else who is a high income W-2 earner, makes about $500,000-$600,000 a year W-2, making great money. But W-2 earners, employees, have very little tax deduction or reduction opportunities. So we talked to them about doing real estate income as what they call a short-term rental, which you might be familiar with, Airbnb. And if you meet certain rules of 7 days or less and you have to materially participate, we can do cost segregation, pull the deductions out, and it creates a big negative number in the real estate category because you have more deductions than you have income. And that crosses over from passive to active when you're running a short-term rental and meet the right criteria. And that offset a huge chunk of his W-2 income for that year, saved him almost $100,000 in taxes. So we had to walk him through the process to make sure he met the right criteria of the short-term rental, did the cost segregation study, and then had to meet with his CPA to explain how to do this because the CPA is like, I don't know how this works. And that's something that comes in too, is having a strategist on your side who can help your CPA do it right and not make mistakes. And so there's ways to cross over. And then the other one, which you might be familiar with, is REPS, or real estate professional status, which maybe some of you reach this criteria. And that's saying, hey, IRS, I'm actually in the business of real estate, whether I'm a broker, I'm a developer, I'm a property manager, or a combination of a lot of those things, which means more than half of my time in working hours is spent involving real estate in some manner. Well, if that's the case, then my entire real estate portfolio generally is not passive but active. So then I can do cost segregation to wipe out other forms of income and keep all my money in my pocket. So let me give you a quick example. I did this presentation for a much longer course with a commercial real estate brokerage in December, early December. Right afterwards, I got a call from two of the guys in the meeting. I guess they didn't want to grab me in person, but they called me up later and they're like, we got to talk. Like, okay, they're like, okay, we've heard people talk about cost segregation, depreciation tons of times. We've gone to all the CE courses, but nobody's break it down like this. They said, we both each make about $2 million a year in taxable income between their successful real estate broker commissions, is about half of it, and incredibly successful cash flowing properties and the income from the properties. Together, they each make almost $2 million of income. That's a lot of money. They're paying over $700,000 in taxes each every year. And so we walked them through. We're actually going to be delivering their studies to them later this week. Their portfolio is around that they co-own together about $20 million of real estate property. So we're doing cost segregation on just two of their properties, two of the biggest. And we are going to hand them by the end of next week about $4 million of deductions. They reach real estate professional status, which means all their 1099 income they get from being commercial brokers it crosses over to active, and all those deductions wipe it out. They're each going to save about $600,000 to $700,000 in taxes on their 24 tax year. And so I told these commercial real estate brokers and investors, I said, what would you do if I handed you $600,000 each? They're like, we would buy another property. I'm like, exactly. So next year, which now is in 2025, when you get that tax refund from the IRS, go buy another property. We're going to do cost segregation on that. And guess what we'll do? We'll wipe your 25 taxable income out with it. And then in 2026, what do you do with that tax savings? You buy another property. Here's what we find. Real estate professionals that understand this strategy can double their real estate holdings every 3 to 5 years by pulling deductions, saving tax bills, and reinvesting, and it accelerates this engine of investment. And so these are the kinds of things when you understand not just the concepts and what the studies are, which I think many of you are familiar with, it's looking at the big picture. What can you do with this? This is very, very powerful. So I got a couple more minutes before we kind of transition to Q&A. One other thing I just want to bring up, and then if you have questions, we can get more into it, is one other thing that it has to do with when you're dealing with issues of capital gains. You all know, if you're in real estate, of 1031 exchanges, right? You're all familiar with 1031? It's so simple. Roll property to another, love it, not bashing it at all. But I often meet with real estate investors and business owners to let them know there are 1031 alternatives. And most of the time they've never heard of it. So the challenges with 1031 is you got what they call like kind, and you have time constraints. So like kind, real estate to real estate. All right, you got to stay in the same type of class, right? Real estate to real estate. Time constraints, 45 days to identify 3 properties and 180 days to close with no wiggle room. Okay, yes, there are nuances of 1031, like reverse 1031, things like that. So they can be very powerful when you meet the right criteria and it's meeting your goals. So what we let people know is there's actually some alternatives. One is, what's important to know about this is there's some situations where this doesn't apply. For example, if you're selling things like a business for a big gain or a primary residence. I met with an owner of a primary residence. He's planning to sell his primary residence for $11 million. It's a big home. And he bought it for about $6 million. This guy runs a successful merger and acquisitions firm. He does very well for himself. He has about, on this one, it's going to be a $4 to $5 million gain, all things said, done. That's a big gain. He can't 1031 that unless he puts a renter in there for 1 year and turns it into a rental. He's considering that. We're like, okay, that's one path. Here's another alternative, and you can see which one meets your goals. We use what's called a capital gains deferral structure. And there's 2 primary ones. One's called the deferred sales trust. Another one's called the secured structured sale. They're structural differently, but they accomplish the same purpose. And that is a structure that gets set up to capture the gain and allow you to reinvest it without any capital gains bill coming due on the time of sale. So that's what 1031 effectively does. You got a qualified intermediary steps in the middle and says, hey, we'll hold your money for you while you buy another property. And then, so you don't touch it. Remember, if you touch the money, it's called constructive receipt. IRS says, give us our money. And we'll redeploy this money into another property. That's what 1031 exchanges do. It's awesome. A deferral structure does the exact same thing. It's a third party that says, hey, we're going to hold those funds for you at arm's length so you don't have it in your hands, and then you get to choose. And what's beautiful about the capital gains deferral structures is you have no like-kind requirements. You can take the deferred tax dollars and reinvest in anything you want, not just real estate. You can do real estate, or you can do a combination, some stock securities, mutual funds. You can put it in private equity, all sorts of things. And there's no time constraints. I can take my time, I can put it in stocks for a period of time, and then when I finally, 2 years later, find a property that looks phenomenal, I can use the money to go into there. And so it defeats these. It's a little more complex, and it can cost more than 1031. So this is why considering options are important. In some cases, 1031 is the perfect fit, and I would tell somebody that because it's quick and easy and cheap. But also, I've seen failed 1031s that don't go through. To know that there were alternatives, people are like, why did I know this? Or someone selling their business There's no 1031 for that. And you can use a deferral structure. So I'm talking to a business owner. He just listed his business sale for $5 million, almost all gain. He's in Oregon, where I'm from. Capital gains with federal state together about 30%. He's looking at a $1.5 million tax bill. But he wants most of this money not in his hands to go live it up. He wants it for investment, for retirement, all sorts of other things. And so we can use a deferral structure to capture the full 5 million, no tax bill due up front, and then you can reinvest it and only pay tax gradually as you disperse money toward yourself. It's a similar deferral structure with flexibility, no time constraints. It's beautiful. And the other thing where sometimes for some investors, it can actually beat out 1031 is they say, hey, when you use a deferral structure like this, and so I'm talking to somebody who's selling a property for a commercial property, could be about $2 to $3 million gain, and he's considering 1031 or not 1031 with one of these structures. If we don't do a 1031 and he uses this structure, he still has the full proceeds to reinvest, no time constraints, and the new property he acquires, you get the new basis of the new acquisition. Now, if you understand 1031s, you know what I just said. The downside of 1031s is your tax basis gets diminished as you roll from property to property. The original purchase basis you paid for minus what you depreciated it. So for a lot of people that do 1031s their whole life, their tax basis diminishes almost nothing. And so that means the gain gets huge. So when you finally exit and you sell and liquidate, your tax bill is enormous. When you use these structures and you acquire another property with them instead of doing a 1031, you get the new basis of that new acquisition and all those deductions. And so it's a double whammy that's really powerful. Now I know there's a lot to this that we can spend all day on. It's its own seminar if you're curious, but I want to just bring it up and let people know there are alternatives and strategies that many people aren't familiar with, which is why we love meeting with business owners and real estate investors just to have them lay out what they're doing and then say, hey, here's some things worth considering that could be very powerful for your situation. I'm going to stop right there, turn it over for any kind of questions or comments or dialogue.
Thank you. The energy you have is amazing. Oh my
I
God.
enjoy what I do. It's fun. It's like
I can tell.
solving problems. I love solving problems. And that's what unfortunately CPAs are often, they're so busy doing tax returns all year that they don't have the time to step back and really sit down with their clients and say, hey, what do you have going on? How do we help you? So that's why we exist.
Well, you have a couple CPAs on here, so
And I'm not trying to put them down.
no, I
We
got that.
and I've had CPAs lament to me of like, oh, we are so busy and we don't always have a lot of time to do this. We love collaborating with CPAs that who bring their clients to us when they have a unique situation. Like, hey, do you know any strategies? And we can bounce back and forth with each other just to help work together to help their clients.
Well, they come on so they can learn because we have different educators every week.
I love that. That's great.
Always something to learn, no matter what. Always something to learn. So, you talked, so 1031 people, what they do is they keep exchanging until they die, and then the kids get the step up. And
Yes.
the kids end up selling the property because they saw what a pain it was for their parents. Unfortunately, instead of
And
keeping the property, which is free
yes.
and clear, they've got a whole new basis.
Yeah, and had coffee with a gentleman in his early 80s just a few weeks ago who was wrestling with this because he's tired of managing his property.
Right.
He does it always known as 1031. He wants to get out. He knows he could keep managing until he passes and then the kids get the step up, which is a great strategy. I'm not trying to not put that down. It's just good for him to know there are alternatives.
Sure.
And
And
that's
we work with people that are tired of managing and put them into other real estate as a tenant in common so that they don't
yeah.
have to manage anymore and they can just get all the tax deductions and all of that. But yeah, there's still the basis thing.
Yep.
That's fine. So is this a DST you're talking about putting your money?
So, one thing to be aware of, there are two kinds of DSTs out there, so I don't want to confuse anybody. There's the Delaware Statutory Trust, which is not
Right.
what I'm talking about.
Okay.
That you can 1031 into. It's a way to just
Yeah.
put money in a real estate fund,
Right.
so to speak. And so you can 1031. It's like kind, but you could be hands off and just collect a rate of return. Um, the DST I'm referring to is called the Deferred Sales Trust. Not confusing at all. They have the same acronym. Um, so there's two key ones. One is the Deferred Sales Trust. And another one
That's the
is
carryback.
called a secured structured, excuse me, sale. Um, anyway, it's two structures that accomplish the same purpose that are very similar, but also some key distinctives. So we meet with our clients and help them consider if they want a 1030 alternative, or if they have a situation where 1031 won't work, these become great alternatives to explore.
And do you have a tax code on that?
Yes, both of them use what's section 453 of the tax code.
Oh, okay, yeah, I know
So
that's,
453 governs installment sale agreements. And
yeah,
so it is a specific application of section 453 that allows you to defer the tax long term.
yeah, I call it carryback, but yeah.
Yeah. But it's another way to apply section 453 is when a seller carries a note and says, okay, buyer, don't give me cash, give me payments over time.
Exactly.
But they take on a risk there because what if something happens and the buyer can't, or if it's for a business, what if they go bankrupt and close the business? So there's risk with that. So this uses the same code section with an installment sale agreement, but the not with the buyer. The buyer still pays cash and is out of the picture, and we set
Right.
a structure that has the same purpose. So I'm not trying to get into the weeds with it, but it's really powerful what it can do.
So someone could sell their personal home and go into this 453,
Yes.
but then when they take the money out to reinvest, they pay taxes on it.
No, so it sits in this structure, and from in that structure, you can reinvest it.
So
Um,
the structure reinvests,
Structure reinvests and grows over time. When they take distributions into their hands to spend, to live on, or whatever their plan is, then they pay tax as they do. Uh,
but they would get a K1, which would offset that, correct?
no, because the deferral structures are managed by a third party, so it's at arm's length, so you don't get a K1 from that. So it continues to grow tax deferred. Um, think of it almost like it's this is not the same, but it's almost like a 401k. That's growing tax deferred. You don't pay tax until you get a disbursement from, but you can be invested in all sorts of things. So it's a similar accomplishment. And so as that grows, but when you get a disbursement, because you're like, hey, I want to take some income off of this,
You
I'll
have
pay
to pay
tax on it.
taxes and you don't, unless you have something else that gives you a tax write-off against that income. Is that considered passive income then?
That would be yes.
That would be
Which is
passive.
good because if you use it to invest in real estate, you get deductions, which then can offset the cash flow from it as well. So that's all part of the big picture strategizing, how to leverage each piece of this.
But I'm not investing, just want to be clear for everybody here because it's not something we really talk about because most people don't know about it. And so I'm going to call it a 453 if you don't mind.
Let's do that because that encompasses the different versions of it.
Yeah, so the 453, the trustees of the 453 are doing investments to build that. So let's say they're investing in real estate. Would that be true that they would invest in real estate or they
So
would?
actually, what's great about this is if you're the seller and you're selling your business or your real estate,
Okay,
and instead of doing a 1031, you do this structure. You get the proceeds are sitting in this structure, and then you work with the financial advisor that or the investment advisor, and they
right,
invest based on your wishes and your risk tolerance or whatever you want. So
okay.
you get to be the one in control via your trusted advisor, just like
Yeah, self-directed IRA.
yeah. So they don't just you're not passive in that regard. It is technically a passive investment, but you could be hands-on. Now you could tell your financial advisor who has all these funds for you, I trust you. Here's the kind of income I want to get. Here's my risk tolerance. Go to town. Or you could be very hands-on and say, I want you to invest in Nvidia and Apple. Not the last week. They all lost money. Uh,
Down 400 points today.
Yes, but you know what I mean? You can be hands-on and say, just like you would with your investment advisor, here's the things I want, here, or you could say, I want this money to be deployed into another real estate investment, or I work with someone who sold his business, used the secured structure sale version of it to capture the full proceeds minus the 30% loss that he would have taken to taxes, and used it to acquire another business. And now that business gives them 30% more to work with. because he's using tax deferred dollars. And that's the power of this is I
Mhm.
can acquire so much more or invest so much more if I pay the tax later. A lot of times these structures are set up so that you don't end up paying the original capital gains for 30 years or more. And what you can do over 30 years time of investing the full proceeds instead of paying the tax is quite significant.
Is there any way to roll this into the Roth IRA?
No, because Roth IRAs like 401ks, there are different types of qualified retirement accounts. And so those are going to be completely different in how they're structures. These can't touch one another, just the way the tax code works and stuff like that. But this becomes another piece of your portfolio.
Hmm.
Um, the
I
key,
understand
those
that.
that like these structures either have an asset that doesn't qualify for 1031, or they want flexibility in, so they don't want like kind restrictions. They don't want to have the time constraints. And they want to be able to invest in other things or at least have options on the table for them. And so it becomes a great, at least something worth exploring. So that's,
Absolutely.
yeah.
Yep. So they don't have any capital gains, like on your personal property. You only
Yeah.
get, if you're single, right, you only get 250,000.
50. So, what if you've lived in a property for 30 years, paid very little for it, it's gone up so much, and after your exemption, there's still $1 million gain. I mean, I run
Exactly.
into scenarios like that. You can use this structure to capture the full gain that would normally be taxable, and now have that part of your investment portfolio. Whether it be deployed in another property at some point, or that could be, in retirement accounts as far as, invested in the markets or whatever you might want.
So can that be used as a down payment and have a loan on the property?
Yes, it could be the deferred gain. So, for example, I said earlier about someone selling a product for $11 million.
Yeah,
They're going to have about a 4 to 5 million gain on it when they sell it.
right. So they're going to
Primary
put
residence.
1 million in
So
and he
his
wants to
original
keep that.
basis, which is around 6 million, he'll get that cash in hand tax free because that's his basis.
Right.
Plus, he's married 500,000 exemption on top of it. So he's going to get about 6.5 million cash that he can do whatever he wants with. You don't need to put that in this structure. We're just going to put the taxable part in this structure. So that's going to be for him about $4.5 million. And now he can use that to acquire another property. His plan is probably to use the 6 million that he gets tax free from his basis because he's downsizing as he's getting older, his kids have moved out, and buy something with that, and then use the deferred portion for other kinds of investments. But he has flexibility. That's the key thing. He could slice and dice it almost any way he wants, which 1031 doesn't give that kind of flexibility. It's still
No,
great
it doesn't.
for the simplistic. This is the way I want to go. It's easy, it's familiar, and it's not expensive either. So anyway, lots of benefits to 1031.
Yeah, so what kind of fees are on this? Because you're having somebody, a trustee, basically.
Yeah, they vary between about 2 to 5% of your deferred gain. So when you're looking at a capital gains bill of federal 20%, states can vary. I'm in Oregon, state's about 10%. In California, it can be around 14, I believe. Washington, I'm just going to the West Coast, that's where I am, is 7%. So you're looking maybe on average about 30% capital gains hit. So to cut that down from 30% taken off the top to somewhere between 2 and 5, depending on the structure and the complexities, because there's a lot to these, that's a huge rate differential, that then can then be redeployed in investments. And usually the fee is within the first year is fully made up for in investment gains. And so when you chart it out at like a very kind of nominal expected rate of return, not paying the tax up front, even minus the fee, ends up putting you, in 10, 20, 30 years, significant higher gains because you didn't take the huge tax hit.
So when is their taxes due on this?
It is as you take disbursements from the fund.
Only as you take disbursements.
So some are like, I want it invested in a growth mode, which means I'm not taking any disbursements, so there's no taxes until I do. Others are like, I just want the growth, or the cash flow dispersed to me, and I'll just pay tax on that as I do. And others want more cash, where they take chunks of the principal gradually. And that's another way to do capital gains planning. Okay,
No,
instead
you're
of
not
taking,
answering my question
oh,
because you didn't let me.
okay. Apologize about that. Go ahead.
Okay. So we'll just use, so I've got $1 million in there and I want whoever's running it to invest in a property that cash flows. I want that cash flow to come back into the DIA to the 453. Is that possible?
Yes, it is.
So I don't have to take a disbursement
You don't have to. Yes.
and I can have that grow. What
Mhm.
happens upon my demise to that
Um,
account?
so these two work a little differently because the structure, the DST, it's a the structure of it is a trust.
Yes.
This, the secure structure cell, they actually create what's called a special purpose entity LLC. Those both are treated differently. With the trust, you would appoint someone to be the new beneficiary of that trust, who would then inherit it and continue on. The LLC structure can actually be brought into your family trust, and that then would be passed to your heirs. In the LLC structure, because it's the assets are in an LLC, itself in your passing would get a step up in basis of all its growth in that portfolio. So these function a little differently as far as that long term. And so that's part of we lock people. Here's how that all works.
And does that have a tax code also?
Um, the
That LLC that can be,
the well, LLCs, it just follows partnership rules. I, there's a number of parts of the tax code that I'll speak to it, so it's not one area. LLC, follows partnership rules, which are the most flexible in the tax code, allows you to do a lot with it. And so this is a trust managed by a third party trustee. And anyway, I know we're
because,
focusing a lot on this part, which is awesome.
well, because we already all know about all the rest of
Yeah,
it.
I figure a lot of the other things is recap and just kind of hitting a couple pieces in case there's any aspects of it that some might not be familiar with.
Yeah, so I've covered a lot of it. So do any of you have, I didn't see any hands up, so that's why I kept talking.
Oh, Gary, I see some
Stephen,
fingers there. What's
yeah,
up?
does
I'm
anybody
just
have
gonna,
any questions?
yes, Justin, as we explain to our clients, I often tell them you can avoid capital gains for 30 years. But when there's a step up in basis, essentially it goes on to the next generation. How long can you, if you live long enough, because if you're not like 70 something years old like you are, or 22 like you are, sorry, meant to make you younger. Um,
I'm not
what
22.
hap what
Okay.
happens if you're 40, you delay it, now you're 70 and you don't want to get that capital gains? Can you turn it over again, or how long can it actually stay in there?
Yeah, there's different rules that can apply to both of these options. But generally speaking, there is a degree to which you can renew the initial note that caused the deferral for and extend it. There could even be ways of kind of renewing the deferral structure and recapturing that again. There's a number of kind of long-term plans. It also depends on kind of where their estate is. If they're approaching the estate tax exemption, of which is right now husband and wife combines like 27 million. It's pretty large. There's it can be rolled into more advanced kind of exotic estate planning. But that's a good point because this is set up, let's say it's 30-year deferral. Effectively at the end of that 30 years, then the full proceeds would be dispersed to you and your capital gains will be due then. But it's the capital gains that will be due will be based on your original sell 30 years prior. So when you're talking about inflation and the time value of money, that inflation, nobody has a crystal ball to know exactly how it will be over the next 30 years. But just conservatively, your tax bill will diminish by about 60 to 70% in compared to today's dollars. So that's really meaningful. But the whole idea is you have 30 years to maximize this money before paying any tax on that, unless you take it in disbursements gradually over that time period, which some do that as well.
And even if we're 70 now, with today's technology, we're going to live past 100. So there's a good chance
Okay.
we will need it. And I will tell you, and I want to tell everybody here, when we do private discussions with Justin, we'll go over all of these different squares and show you how the trusts work and how you can invest the money. And it's really quite fascinating.
And big key, what you just pointed out, Gary, is everyone's situation is different, have different assets, different taxable income, and different goals. So even in calling my business Elevated Tax Strategies, our goal is not to sell you on any particular strategy. It is to help elevate your tax strategy. So we want to educate you on different opportunities. Sometimes it's a combination. How do we leverage this structure and cost segregation in acquiring another property to offset other kinds of gain. There's a number of sometimes ways you can piece things together. But a lot of it is just to kind of lay before you, hey, here's a strategy you may not be familiar with or how they can be leveraged to help empower you to make the best decisions for yourself.
It's been really great. Anybody have any questions? Stephen?
I do actually. Hey, Justin, I'm actually a CPA, so I'm one of these people that is unfortunately doing tax returns right now. But
I'm so sorry.
so on these DST programs, so are
Yeah.
these proprietary to you somehow in your group or not? Like,
No, well,
is what you've crafted the
no,
trust something
I
that's
get it. So
yeah.
deferred sales trusts, there's a number of different teams across the country that do them. We have a particular team we work with that exclusively does deferred sales trusts that we have vetted and we recommend. They've navigated audits with the IRS, come back no changes, totally clean. So we have a great team that does this that I highly recommend. Been doing it for over 20 years. The secured structured sale, that is a bit more of a it's same code section, very similar structure, but with a different kind of entity structure. There's a particular team that I work with. They technically exist independent from me, but they have been doing this for about 24, 25 years. I've done over 100 of them, been through 9 different audits, one with the California Franchise Tax Board, all no changes or adjustments. So they got a great track record. But there's a lot of similarities between the two, but also some key differences that could sway somebody one direction or another. But we work directly with those teams. So this is one particular team because it's their version of how they create a 453 installment sale for tax deferral. But again, if you ever want to explore one of those or meet the people that do it, I'm happy to set that up.
Can I ask you just a big picture question? You're talking about a percentage of the capital gain deferral, but what like is basically, I mean, what's the cost for these? Like, is there an upfront cost to meet with
Oh,
someone and like,
yeah. So everything that we do, we help people learn and explore and consider before any kind of engagement or cost is ever incurred. So all that for both of these structures and anything else to bring up, we get everything on the table. So you have everything to look at, including the legal documents, before you say that this is what I want to do, and now you're committed. And then yes, there's fee structures. I mentioned Peggy asked me about that. Between these two, it's around 2 to 5% of the deferred gain. There's nuances and variable. We walk through that so that someone knows what their situation, what it's going to cost
but
them.
no upfront cost per se.
No, yeah,
No.
that's when okay, we're rolling the funds into it. Now there's a cost because you're committed. But the
Right.
exploration, and that's a bit how we've structured our business. We do presentations like this and we'll meet one-on-one, give complimentary tax strategy consulting at no cost so that people can explore these and determine if it's the route they want to go without having to pay someone just to help them consider it.
So
And so, yeah, we would work with you, your clients, all the way through until the 11th hour when the funds are going to come and then they decide, do I want to do this or not?
Justin's answer was great, Stephen, but the simple answer is no, there's no cost. Simple. We do
But I don't want them to think they can defer their taxes for no cost.
everything
Of
we
course.
do, all of our different tax strategies, our Champion Health, everything that Brad, myself, and Justin do, we do not charge anything upfront. We have an attorney that can restructure your business. That's going to be another call, maybe in the next month or so, and really help. So, Stephen, I texted you or I private messaged you with my number. If you'd message back, we will get in touch after tax season, March 15th or April 15th, whatever it is good for you.
Oh, sure.
And thank you, Peggy, for everything that you do.
Of course.
Even with that, was there anything else following that? I didn't know if you had any other questions.
Yeah, and Justin is actually, no, he's about 22, but he has a lot of experience. No, I'm kidding.
I'm almost double that, Gary.
That's good. Does anyone else have any questions? We have lots of Garys on today. Lisa, what about you? Lisa has a single family home. And we did talk about cost segregation for her, but she's had it for so long. I don't know that that would ever work for
Well,
her. It's really
for-
expensive to do.
Yeah, for cost segregation, what's great is as a consultant, our team doesn't do the studies. We work with a variety of cost seg providers. So part of what we're providing at no cost to our clients is we'll shop it for them. We'll get several proposals
Yeah,
and try to help them find the right firm that's going to provide the price and the benefit they need. So that's a lot of what we do for people. Like, okay, you're considering cost seg. Hey, we'll get a couple different proposals from different companies. We'll do all the legwork. It's almost like an insurance broker getting quotes to say, okay, here's the best provider for that policy. We'll do that for cost seg as well for somebody. So they
right. And it just doesn't pay when you've only paid 30 or $40,000 for a
Oh
property.
yeah, I mean, there's times where it's all a numbers game. All our strategies, it's all a numbers game. What's going to put you in the best position? Sometimes the numbers just aren't good enough, and okay, not worth it. And that's what we
Right.
help people explore.
But it might be good next year or the year after, or you might know somebody it does work for. I cannot tell you how many times I've had people refer clients, oh, that'll never work for them, but they knew someone who owned a $10 million company that they golfed with on Saturday or Sunday, and business came from there. So we're willing to help anybody that we have an opportunity to, and educate for now. Educate to advocate is what we say. So you can
Oh,
advocate for us now, or listen, Peggy, as I said earlier, 5 years we've been working together, and you just never know who you're going to run into when. And
that's
Stephen,
right.
there are some people on here from Wisconsin and other parts of the country, and they are always looking for a good CPA and one that's not entirely bald. So I think you might qualify.
You're funny.
Yeah, well, finding a good CPA, there are challenges, as you have said. They're just filling out tax, and that really the most important part in my eyes for a CPA is that they support you throughout the year to make sure you're meeting your financial obligations and you're staying on track as to what you determined you're
Yeah.
going to do.
And
Ethan,
Peggy, I so affirm that where our job is not to come in and interfere or replace that, but only complement it. I
sure.
so appreciate when we work with a client and they introduce us to their CPA who's doing a great job for them. And we're coming just saying, hey, we're just going to see if there's other opportunities that we can all explore together to see that might benefit you. At the end of the day, your CPA is your tax advisor, and you want to lean on them to work with us to explore any of these things we talked about today. Our job is not to tell you what to do, but to at least show you opportunities, what they could mean for you, and then you work with your tax advisor to decide what's best.
Yeah, so we tell people that are interested questions to ask a CPA or their tax advisor before they hire them.
Yes.
Do they know about? And I'm going to add this 453 to that list of,
And I can tell you, most CPAs aren't very familiar with it, and that's not to put them down. They know so much and they do so much.
yep.
There's always going to be areas that just outside of what they're doing day in and day out. And so that's why,
Yep.
occasionally we can bring unique opportunities like this.
And my CPA goes to whatever the IRS offers every year for his education to keep it up. So that he's up on all the latest rules, regulations, and whatever will support me in not paying taxes again for another year.
That's great.
Yeah, I love my guy. Ethan, do you have any questions? Or Lindsay? I know you guys came on, I know Lindsay came on a little late.
Lindsay is an associate of mine, and I
Okay.
must tell you, in all the years we've done this, Justin, everybody has PowerPoint slides. I don't think I ever remember anyone using a whiteboard.
Pulling out a Sharpie and a thing. I like to just say, let me write stuff out. It just feels conversational to
That's
me.
good. That's good. Because
PowerPoint feels so professional.
I
Gary, some
think
things
you're,
like the Champ Plan, which is a great program when they guys share that you should listen. That a PowerPoint's better because you got a lot of details that need to be covered importantly. But this kind of stuff, it flows better like this. So
and
again,
here's what's really great, Justin. You have very nice handprinting.
that's what I learned in when I taught middle school for 6 years, and I had to get good so my kids could read what I was writing. I taught like math and history for middle schoolers a long time ago. So anyway, but again, you can reach me at justin@elevated.tax or Justin Ruby. You can find me on LinkedIn. We're always up for having conversations because this is what we do. Because we don't do tax prep, we're not crazy busy right now. We're normal busy. So we can have these conversations any time of the year. I always tell people ask me when's the best time to connect with you. I said sooner than later because there's a handful of things you can do looking backwards for tax savings, but it's very limited. Most things for tax savings are a conversation about looking forward. And that's what we're really focused on. So the sooner you do that, the better position you can be in.
So let me add one or two things, and one of those people might still be on here. I'm not sure of the name that they're listed as. But better not to talk to us December 20th, 25th, or God forbid, December 31st, because you might miss out. And if you're about to sell a business or property, call us before you do it.
Oh, I can tell you those 453, the tax deferral structures, those have to be in place before you close your sale. So it's important to proactively, let's see what's the best strategy. But I have come to people they've already sold their business. The capital gains is due. I talked to somebody that just did it, but I
Trust me.
told he wants to invest in real estate. I said, "Oh, let me tell you about cost segregation, because if you buy a property with those business sale, I can't eliminate the capital gains now. Too late. However, we can do cost segregation on the new property and bonus depreciation, and we can offset your gain on your business sale, because cost segregation can do that." So he now is saying, "Oh, I can still have big tax savings by leveraging my real estate investment that I'm buying with my business sale proceeds." So that's another pathway. You know what? I won't do a deferral structure. I'll just buy property and then do cost seg. So that's when you look at everything. You say, "Hey, what opportunities do we have on the table?"
Hey, Justin,
Okay.
is it Justin at elevated.tax.com?
Elevated.tax, no .com. Just, they have all different.
Oh, at elevated.tax? Okay,
It's
great.
just Justin at
Okay.
elevated.tax.
Got it.
Or my
Stephen,
website is www.elevated.tax.
okay, Stephen, did you get your questions answered? And do you
I
have any
did,
other
yeah, I did
questions?
from a big picture. I'm gonna reach out to Gary,
Okay,
after next week. Yeah, I will have some additional inquiries. So,
Oh, good.
okay. I just wanted to make sure, because we're at the top of the hour and you
yeah,
had some questions. I wanted to make sure everybody who had questions.
this is great, Peggy. This
Ted,
one
do
was
you have any?
great. Yeah.
Thank
I
you.
appreciate the feedback, Stephen. Thank you. I
Ted, do you
respect
have any
you and your
questions?
expertise as a CPA, and I'm glad I could provide some value.
And
Let me finish asking everyone if they have any questions before we go, okay?
Lindsay did, but she went back onto mute, so we kept talking and she didn't get a chance to, so I'm not sure if she wants to or
So
not.
Lindsay, are you still there to ask your questions?
Oh, yes. No, thank you. I don't have any questions at this time, but I appreciate the presentation, and hopefully we do it again so I can see the rest of it a second time.
Okay, well, we're setting it out. I don't know if you came in as yourself, so you probably should get a copy of it. And then I wanted to know if Ted had any questions, because he usually does.
I'm a CPA also, but I don't do tax work. Um, I'm looking at it from the point of view of let's say, your customer or investor. That is, how do you and let's say Justin and Peggy work together? If we were looking at this from the point of view of, let's say, building a house, who's the general contractor? Who are the subs? And what subs do we not have on this call today that we would
Okay,
need?
so Ted, I love that analogy, because I've used that same analogy when I've explained how we operate. I've talked about my company, Elevate Tax Strategies. We effectively are kind of like general contractors when it comes to tax strategy. And then my subs are going to be the different specialists that specialize in the different strategies. So like I have four different companies that do cost segregation studies. I'd call them all my subs. And then the deferred sales trust that I talked about and the secured structure sale, two separate teams operating in their own firms. They're my subs for those strategies. And I have a variety of others depending on what the needs are. So, and you can also further extend it when I work with a CPA like Steven, and they're the tax advisor for a client. We come in as kind of a niche specialist in strategy, who then bring behind us our network of subs, bring the specialist to the table as needed. So that's a little bit of how we operate. Does that make sense, Ted?
So far,
Now the subs tend to want to charge money when you start really getting into it with them. So that's why we exist to like, hey, we're going to help you explore this. For the most part, we don't charge anything. We get compensated in a form of revenue share by our subs. So at the end of the day, if you decide you're going to go through with one of these things we're doing, there's a fee for that. We've already determined that it's worthwhile with you and you've made that decision. That's how we get compensated on the back end. So it frees us to be able to do conversations like these, either big presentations or one-on-one at no cost.
Okay, good.
All right, it's 3 o'clock.
Anyone else have anything? Well, we are now at the top of the hour, and this was the most interesting, and I want to thank you very much, and I hope you'll come back again.
It was. Let me just add, Justin, Gary, and Ted. Are you the guys that work? Do the
Oh,
three
it's
of you work
Brad.
together?
Brad Birch here.
Oh, Brad. Okay.
Pirate. He had an
Brad.
eye surgery, excuse me.
I can't see him, but okay.
Yeah, we collaborate together, but yes.
Okay, great. Thank you.
Thank you for having me, everyone. I
Thank you.
appreciate it.